me welcome on board Kanika Pasricha, then Chief Economic Advisor at Union Bank of India, and figure out what she's penciling in terms of her expectations. Kanika, hi, good to have you on the show. Is it a status quo from you as well? What are you penciling in for the policy this time?
Yes, so first of all, thanks a lot for having me on the show. Yes, we are also penciling in a status quo in terms of rates, but as you also stated, it's about the liquidity measures which are on bigger watch in this policy. All tools on the table: CRR, OMOs, FX swaps. The only bias we think why CRR may not be preferred in this policy is because the RBI is likely to revise higher their inflation projections. In fact, for this quarter itself, after the October CPI shocker for RBI, so we were at 6.15, but from RBI projections perspective, October to December, their projection for inflation is 4.8. It's tracking 5.5 as per our estimates. But the catch is, by the last quarter, so an upward revision in inflation projections for the full year of 4.5%, likely to be closer to 4.7, 4.8. But for the last quarter of the year, we think inflation likely to align towards RBI's projection of 4.2% after the 42% inflation and vegetable squares off as per seasonal trends. So we think near-term inflation a worry because of its status quo on rates, and maybe CRR, more than CRR, other liquidity tools may have preference like OMOs and FX swaps, but it's going to be a tough balancing act for the policy this time. Thanks.
Hi, morning. I wanted to get your take on the GDP growth as well. Given that we did see it at a 7-quarter low, do you think that there will be a revision by the Reserve Bank in the growth target?
Yeah, definitely. So if you see their growth numbers for this quarter was 7%. And the RBI has been giving slightly more optimistic bias on growth numbers, not just for this quarter, but for the second half as well. With the threshold itself falling lower for July to September quarter, there's a likelihood of a sharp downward revision in growth numbers as well, which is why I talked about that tough balancing act. So they're at 7.2% for the full year. We are at 6.4%, downwardly revised from 6.7 after the GDP number. In the second half, RBI expects 7.4% growth numbers, which we think that given, while of course government spending pickup, rural demand recovery likely to support growth, but in a volatile global environment, private capex gets deferred further, credit impulse is weak. So from an overall framework perspective, a 7.5% growth number in the second half looks difficult to achieve, maybe closer to 6.5 to 7% for second half, making the full year number aligned towards 6.4, 6.5 with a downward bias.
Okay, fair enough. And what's your outlook then in terms of the depreciating currency? Do you think that the Reserve Bank could potentially step in to curb this?
So, see, frankly speaking, in terms of the depreciating currency, the Reserve Bank is actually stepping in to contain volatility. The policy argument they've always stressed upon, it's part of their overall reaction function as well. So if you actually see FX volatility and steps undertaken to curb that is clearly signaled in numbers as well. So when the forward position numbers for RBI came out for end of October, it showed a short forward position of around $50 billion, up from just $15 billion short at the end of September. And while the spot intervention numbers are awaited, but just looking at liquidity numbers, we estimate that more than $25 billion have been sold out on account of FX outflows. So pressure on the currency remains, which is why the RBI has stepped up efforts in line with their objective to contain FX volatility. In fact, we have a view that in a volatile global world, which may stay volatile at least till Trump takes office on 20th January, that is curbing monetary policy flexibility of emerging market central banks globally, including the RBI as well. So which is also an additional reason why rate cuts may be deferred to February rather than we see one in December itself. Thanks.
Right. You know, Kanika, to the other point that you were making about how liquidity is the bigger issue right now while it's going to be a status quo, wanted to understand what tools do you think the RBI has at their hands right now to try and tame down liquidity? I mean, do you think it's going to be some OMOs or even a CRR cut perhaps?
So, first of all, what are the tools? In fact, RBI has many tools in their kitty. Three key tools that we talk about is CRR, OMO, CRR cut, OMO buyback, or buy-sell FX swaps. Now, this week itself, we are hearing about buy-sell FX swaps being conducted. So, it may be part of neutralization of sell spot FX trade itself. So, that's not clear that what has been the liquidity impact, but it is one of the tools. CRR, from an old school economics perspective, has traditionally been used in periods when RBI was in an accommodative stance. It was always used as a policy signaling or a rate signaling tool. Somewhere we believe that CRR cut shows that RBI is confident about inflation outlook, even after the fact that they are likely to miss the October to December inflation by a huge margin. So while it's an inflation targeting central bank and the MPC, they are comfortable with inflation being above their threshold level, while growth worries are taking precedence. That's what we think the CRR cut may show. So our bias is maybe CRR cut may not be used, so the probability still remains, given that growth has surprised them significantly on the downside, and it may be a preparation for a rate cut in February. But apart from that, they have other tools in the kitty which we think may have preference, like OMO buybacks, FX swaps, among others, to boost liquidity.
Right. Okay. Good to have you on board. Thank you so much, Kanika, for taking us through the macros, what the expectation is from the Reserve Bank, and how we can see things shaping up on the growth front as well.
If you like this video, then like, share and subscribe to ET Now.